Stocks are rallying broadly today on strong earnings that he mentioned from the banks, better than expected economic data. But consumer sentiment is still under pressure from high inflation and worries about the economy. Do these latest data suggest the skies are clearing? Joining me now is Jason Brady. He is president and CEO of Thornburg Investment Management. Jason, what do you make of the outsized action today?
Look, I think investors are absolutely concerned about inflation. It's certainly the number one question I get from almost every client. I think what we're seeing here is a little bit of a loosening of the supply chain bottlenecks of the goods prices problems. But what investors really need to keep in mind is the housing price challenges that are out there in the context of how that feeds in, and also wage pressure. So those are the two things that longer term I'm much more focused on than simply this supply chain challenge.
So housing, wages, does all of this make you bearish then on the economy?
No, actually, I think the economy is doing pretty well. The recovery, bounce from the continued pandemic recovery is wonderful, but it's starting to show some side effects, right? So what we have, high CPI or high price increases, high wages, those are good things, right? That's a recovery problem, a problem we'd love to have. But right now, it's a problem that the Fed has. And ultimately, what we need to look at and what we'll see is, are they going to, throw a little bit of fire extinguisher into the mix of this flaming economy.
So absolutely, people are wondering just how much they might want to tap the brakes here. Obviously, the taper they talked about yesterday in the minutes and kind of the fact that it is looming, but tapering by $15 billion a month still leaves a lot of purchases or however that number is going to shake out. So, what happens then if people, let me sort of ask it to you more tactically, where do you think the market heads if the Fed is possibly tapping the brakes or if high prices themselves are slowing the economy?
Sure. So what you're really looking at is a rates question. And one thing that is extremely important for all investors, I think, to understand is the correlation of interest rates and equities is really high and extremely important. So if you look at, for example, long duration growth stocks, if rates rise because potentially the Fed is tapping the brakes in the context of a strong economy, and growth stocks may look like those skinny jeans in your portfolio. You might have a few too many of them. And that's really the challenge, I think, of asset allocation and of portfolio construction.
Well, if they're like skinny jeans and the fashions are changing, then what do you think people should be adding here?
So I think folks are generally underexposed to some cyclical names. We really think financials have some continued room to run here, as well as make sure you have a little bit of international exposure. So these are very typical exposures for folks to have, but at the end of a really long, strong growth rally in the United States, maybe people are a little bit underexposed. All
right, Jason, thanks. No comment on your own skinny jeans situation. Jason Brady joining me from Thornburg Investment Management today.